Hi everybody, I am Joseph Bramante with Triarch Real Estate Partners. In this episode, we're going to go over an 850 unit deal up in Oklahoma City. As a reminder, we are doing all this so that we can educate passive investors on how to analyze the analysis, how to break down these investment packages that are being given to you with limited resources, and doing some little tips and tricks to determine if it's a good deal or bad deal. If you're a syndicator watching this, pay attention as well. We're going to be showing you some do's and don'ts about the field. And just remember, your investors are our investors and our investors are your investors. So it's up to us to really look after the whole investment community. So without further ado, let's get going. Let me share my screen. All right. So here we have an 850 unit deal up in OKC, Oklahoma City. Attractive price right away, $50 per door, which is always, one, you don't see those prices that often. So I'm always speculative of why is it so low. Built in 1970s, 45 acres, 55% occupied, as I said. So also keep in mind, that's also a kind of a red flag for me. If I'm looking at a deal is 55% occupied, it's probably there for a reason. So just keep that in mind. One of the things that's missing here is a cap rate. I don't see any cap rate calculation, so don't worry, you can easily calculate that. Now let's jump. Actually, let me pull up. I'm kind of skipping through. I've taken some excerpts and pasted them here. I'm going to read the actual package off to the right side, trying to preserve some confidentiality here. And just the excerpts I have are strictly going to be the uncensored data. So right away in the beginning of the package are kind of boasting all the groups involved. So you got a lot of groups here, which, that's nice. Talking about their experience. Looks attractive. You see, looks like the lead guy here is boasting 12 years of real estate investing and construction experience. Just be cautious. Sometimes they'll say, they use vague words. You really are looking for multifamily investing experience, not just real estate in general, because again, as you probably know, single family and multifamily are two different animals. And this particular gentleman, I know for a fact, has only got 2 years of multifamily experience, and the rest is all single family. So you see how you can kind of fake the funk there a little bit and make yourself appear a little bigger than you are. You got another team here. This second gentleman here looks like $500 million worth of real estate. Nice. Overall, decent team. I'm going to do a separate podcast on kind of combined years and experiences and whatnot. So really you're looking for 10 plus years experience, especially on the lead guys, specifically to your market, specifically to your asset class, because it's a very complicated industry. Here they're talking about the manager company involved. Manager companies are doing this for 15 years. Okay, not bad. And that's about it. And then there's an asset management company involved, which, I just start to get a little nervous because now you got a lot of cooks in the kitchen here. You got a property manager company, you got an asset manager company, you've got, I guess, the syndicator. Typically, you're just going to see a syndicator who's also the asset manager, and then you're going to see the property management, because if you're buying out of state, you're not going to self-manage your deals. So when you get, again, too many people, it's hard to make decisions when you have that many people. Okay. Here they talk about their combined experience. Cool. Location, they give you a general map of OKC with a bunch of stores and stuff around it. Cool. They talk about OKC, the MSA, number of population, GDP, unemployment's at 3%, 27th largest city in the U.S., and 54 best for business. Okay, cool. Here they talk kind of rising wages, just your normal market stuff. Nice. Now we're on a slide about affordability. So affordability is the city's becoming more affordable. Okay. I mean, that could be construed the opposite. If things are more affordable and expensive, could also suggest a weakening economy. But a little plug here for the marijuana industry apparently is now in OKC as of 2018. I think I would want to check Colorado and see how that's doing for them, because there's a lot of states doing the marijuana thing now, and it's, back when they was first legalized, it was a lot more successful, but now they're getting diluted, so that's slowing down quite a bit. So it's the impact and the surge, from what I've read, is not as prominent as it used to be when, like when Colorado was the only state that had it. Here we go into some property characteristics. Really cool stuff. It's got a 30,000 square foot fitness center, gym, cardio, basketball courts, tennis courts, boxing ring, Olympic sized lap pool, clubhouse, executive space, business center, playgrounds, walking trails, security gates, 5 swimming pools. I mean, this property is a monster. That's the other thing you got to keep in mind. There's a kind of an exponential graph, and here I'm going to draw it here for you. Let's see if how I can do with that. So as you go, I think it's like this, and then something like that. Basically, what we're trying to show here is your effort, and then the bottom, units. So basically, as you have very few units, it's very hard, and then as you get more and more units, it gets easier, and then you get to the to a point where you're at 500 plus units, and then it starts getting hard again. Now, I probably misdrew that entire graph, but you can see the point here. Property characteristics showing photos. Photos are cool. All right, now we're to this chart right here, property characteristics. So finally, page 15. They do a pie chart. Great. Here you're showing floor plans. As a passive, I'm not sure why you would care about the floor plans of a unit. We're doing a new development right now, and in those cases, you do share the floor plans because you're creating it. So it's something that people have input on. But here, there's really no input you can have on the floor plan. Talk about the public schools. They talk about the elementary school, property characteristics. So there's a middle school now. And now we're getting into the business plan. And the rest of the package I have cropped in here. So, all right, well, let me jump back to here. So the next page, they show the rent schedule. Package too many times, that should be kind of a red flag. It's kind of like misdirection, like a magician would do. $767 per month is the rent. And if you look at their table, a little, again, just being sloppy here. Earlier it said it was built 1970. Yep. And now on their chart, 2008. It doesn't really have any impact, but it just represents sloppiness. So it makes you wonder what else did they miss. Here you can also see the columns are not spaced correctly because you can't read what's there. You got formula, the green things are formula errors, and you got grid lines all over. So just automatically I look at this and I think amateur. Like, this isn't really professional, and you're doing a very large deal at 50 plus, what is it, 40 something $million. You would expect a higher quality package. Now we get into the GP cut. So here they talk about 850 units again, and just some general stuff what they're doing. You've got your LP projected IRR, 17 to 18%. On a deal that's 55% occupied, you would expect a much higher return because you're taking a much bigger risk. So why would you invest or go out at 17, buy this property that's obviously not doing well, and then only get a 17, 18% return? You would expect something in the 20s. Total projected returns and equity multiple, they're the same thing. He's showing a 2.04. Okay. Again, you'd probably want that closer to 2.5 if for this kind of deal. LP average cash on cash. Equity raise 13.8, projected term 5 years, so it's a 5-year hold. 1.5% acquisition fee. Okay, not bad. Minimum investment 100,000. Class A members 8% pref. Equity waterfall. I don't know how you're going to do an IRR waterfall and an 8% pref because they're one and the same. If you have an 8% IRR hurdle, then you kind of by default have an 8% pref return. So there's really no difference there. So anyway, what really alarms me though is, especially these last ones, 16% IRR to get a 50-50. One, I don't think any syndicator should ever take 50% of a deal. I don't care what the IRR is, 50-50 of the deal is just way too high in my opinion. At 12%, getting 40% of the deal over 12 is even very, very rich, a very big ask. I think 70-30 over an 8 is pretty standard. I would expect a little bit lower, maybe 75-25, but again, that's, every GP has their own deal. Also, typically these rates, these numbers here are representative of the experience of the GP. So the more experienced the GP is, the higher the promote you would expect them to have. So this promote structure is what you'd expect for a very experienced GP, not necessarily somebody who's been doing it for 2 years. For a less experienced GP, you would expect something closer to probably 80-20, 85-15, something like that. Their cap stack. So this is just how the total cap plays out. So again, 850 units built in the 70s. Purchase price 50,000. So you've got your debt of 37, common equity. Year one NOI of 4.2 million roughly. Terminal cap rate 6.5%. So they didn't show your actual purchase cap rate, but I calculated it right here for you. It's 4.2%. So you're buying a 55% occupied deal at 4.2% cap rate. That is extremely, extremely aggressive. You should calculate your cap rate right out of the gate. So that was 4.2%. And for me, I would have probably passed right there. But if you're curious, you can keep looking. Loan amount, 37 million. So the way bridge loans work is you've got a total loan amount. Typically, we would have shown it as your loan amount plus your construction draw. They didn't show the construction draw, but basically I'm assuming that because it's a bridge, that construction amount's built into the loan. So they're going to have a construction draw of 4.8 million. So the actual loan amount is going to be closer to like 32 million. They're going to draw down the 4.8 over a period of 12 to 24 months. So the loan is actually going to ramp up to 37 million. Here's a chart on their previous CapEx. So you can see basically 10 years ago, they put all new roofs on the property, installed French drains and landscaped areas. They did a new dam and lake erosion controls, which, okay, that's interesting. New roofs placed on the villas, new roofs on selected buildings. So I see a lot of roof issues over every couple of years. So just something to look at. Then major landscaped improvements. So looks like they spent a lot of money on landscaping over this period. So now let's look at the CapEx for here. So they did a decent job breaking it out. I can tell the guy was a GC because this is how a GC would break out his CapEx. You've got your exterior carpentry. You've got your exterior paint, all 850 units. So this number is a bit high for us. Typically when we're painting units, it's on exterior. We're between like 400 and 500. If it's all brick and we're painting the brick for the first time, it can go 600 to 700. Anyway, it's a little bit high for us. And also keep in mind that all of your price per unit numbers are going to be skewed down for this many units. So the typical benchmarks you have aren't really going to mean much when you have a very large property because you get a bigger and bigger economy of scale. So those price per units are going to go down, which is another reason why these large acquisitions are so hard. Drainage. So here I just circled, they've got the description is copy and paste. It's the same thing, which isn't normally a big deal, except for this particular item that they've screwed up the description on is the largest exterior component. And so I would want to know what it was. Also, because they previously did a lot of drainage work. You saw in that 10 years ago, they redid the dam and did a lot of French drains. So now you're spending another $232,000 on drainage work. So I really question what is the makeup of that, and is there any flooding? Should I be concerned? What's going on? The roof. It just says remove and replace. This cannot be for a full removal and replacement because a full removal and replacement is going to be anywhere from $1,000 to $1,300 a unit. So that's close to $1 million. This is $100,000. So that's too big of a gap there. So I'm just going to assume that they were correct and we don't have enough details there, but just keep that in mind that a typical replacement is going to be a lot more expensive. So interior paint, $1,300 a unit. That is way too high. Typically we're painting units for $400 to $500 a unit, maybe a little bit more if it's a bigger square foot unit, but never anything close. $1,300 for a one bedroom. Come on, man. So the only way this makes any sense is if he's including the resurfacing as well with it, but it's not stated. The line below it just says finish out upgrades. So you don't really know what the details are. You probably want to see at least one example of a detailed breakout of a typical unit renovation so you can know what's going on. Major components, let's see, everything here looks okay. We saw previously they replaced all the HVAC, so you're fine there. Looks like they're just doing some spot replacements, which is good. And then, yeah, amenities seem fine. Dog parks, okay. Fitness center, paint upgrade, add equipment. Fitness centers can be expensive, especially if you're buying all new equipment. You really just want to see what the breakout is. What was missing here for me was a contingency line item. That's a big one. I always have a contingency. At a minimum, you want 10% contingency going on your deals. Reason being is, the argument is that you could just put a little bit of fat in your numbers, so to speak, so every line is a little bit heavier than it needs to be, but then you forget about the contingency. So you really want to break it out and have it as its own dedicated line item at the bottom so that you can see truly what is your kind of rainy day fund for when things go wrong on these kind of deals. So I would have added $418,000 of contingency. So if this were my deal, breaking out, assuming everything else is correct and putting in what we know for paint, minor things, would have been at about 42 million in subtotal, 4.2 million subtotal versus 4.18 million. So not too far off. But the big one for me is this construction management fee. Typically on the GP side, if you're doing a construction management fee, it's between 5 and 8%, not 15%. Our deals are 5%. Now, if you're the GC on the deal, your promote's going to be built into all the line items above that subtotal line. So they're typically going to be getting 15 to 25% profit margin on every one of these line items above. So just keep that in mind as well. We would have been doing this for 5%. That would have been a $200,000 cost versus $627,000 cost. So overall, I mean, I think they're 400,000 high, but not the end of the world. The next one and the important one for us was the gap residential analysis. So this is a technique that you're probably not going to do as a passive. As a syndicator, you really need to know how to do this. If you want to learn how to do it, take the CCIM course on advanced market analysis. And what I'm going to do here is just kind of give you a gloss over review of it. But basically, you put in your market area. That was an old carryover number. You put in your market area. You put in what the total supply of units is, overall vacancy. Here, I made an assumption on the vacancy. I had to go in. So, and this was the 1 mile radius. I put in basically the vacant units plus I assumed the market, the vacancy at 8%. So I was conservatively choosing that the whole market was 8% vacant, and then added on whatever the vacant units were for this property, which apparently there's not too many units. It looks like this property is about 30% of that whole 1 mile radius. So that's going to definitely influence things. I actually did this on 3 different sample sets. I did on a 1 mile radius, a 2 mile radius, and a 3 mile radius. The larger your radius goes, the less kind of reliable the data becomes because you're looking at too big of a swath. You really want to keep it down narrow enough to the radius that your likely renters will be within. So a 3 mile radius is pretty indicative of an area a resident would live in who might be living there. So the way this works is you put in your data. Over here, you've got some forecasted market growth rates that comes from the census data. Ours is coming from ESRI, and they give you a population growth rate and a household formation rate. With these 2 numbers, you're able to then take what the current market population data is and forecast that, and then also take the current household data and forecast that. Here's the actual sample set of data where it all comes from. See ESRI. And then you're able to perform what's called a gap analysis. So you're able to say, okay, here's my current market conditions. Here's my demand for units. Here's my supply for units. And then you're able to do forecasts. Okay, a year from now, here's my demand. Here's my supply. And then we're able to go and further and forecast a stabilization, which for this particular property, because it's already at 55% occupied, is a very key calculation that needs to be done. So again, we took this at 1, 2, and 3 mile radiuses. We did the same calculation over and over again. And what we determined was that it'll take, on the 1 mile radius, 386 months or 32 years to stabilize at 92% occupied. But again, this property is 30% of the market, so we want to go bigger radius. We did 2-mile radius. That was 154 months or 12 years to stabilize. Again, we felt we could probably go a little bit bigger. So we did a 3-mile radius, which again, that's 6 miles across. Came out to 52 months or 4.3 years to stabilize, which we felt was probably more realistic to actual, plus from what we've experienced in the past and what we've seen in the past from these very large properties that get in these bad situations. Which again, another fault with these large properties, you've got, it's like having a very big boat with a very tiny rudder. It takes a lot of work and a long time to steer those things and to get them moving in the right direction. But looking at that, so basically we have the 850 units. You've got 46.7 occupied and 382 vacant. If you take the vacant divided by the 4.3 years, that gives you an average of 89 leases per year or 7 per month. In their package, they referenced a 40 per 50 leases per month. So obviously there's a very big delta there, 4 to 5 times delta between the statistical data and what they're predicting. So here we can see we have their proforma. Again, they're giving it to you in PDF. I went ahead and took the time and just transferred everything over to Excel and just kept it all year over year. If this was our actual, as a syndicator, we do everything month over month. So we have it all by month. I think a lot of you do as well. So just keep that in mind. You really don't want to be doing year over year calculations because it's too broad. So you want to be more precise, especially on these very big deals where every little bit counts. So right away, the first thing I saw, loss to lease. And if you saw the previous episode, I did a really big thing about loss to lease. The vacancy would also be an issue for us because we showed it's going to take 4 years to stabilize. And then the concessions were concerned. So typically when you're doing a big lease up like this, you're going to be marketing to these investors to get them to come to your property somehow. So the way you do that is through concessions. You give them free months of rent, you give them special rates, you do all kinds of cool stuff for them, free TVs, you name it. And so that's what that line is for, is the concession line. And so right away you're looking here and you see, man, the previous guy had $934,000 in concessions. This guy's going to lease it up somehow and then drop the concession to $153,000. That's just not adding up. Also, it looks like they're going to turn all the down units, which, that makes sense. You can certainly get all these ready, but you would have some vacancy loss on those downs because it's not an instantaneous thing. It would ramp down from them having a vacancy in month 1 to no vacancy in month 12. CAM expense reimbursements, I believe that's their RUBS. I would double check that because it's not referred to as RUBS, so I'm not sure what they mean by that. But typically reimbursements, you can get reimbursed for utilities up to 75% of your gas, water, and trash. Total other income, they increased that by $25,000. Okay, fair. You'd want to see where's that going to come from. Here, total revenue. So again, you can see there's a little green arrow there. That means this formula here is different than the others. So makes you wonder, why is that one different? What's wrong here? Is there an error? What's up? Payroll expenses. So actually, let me just scroll over to the other side. So here you can see I've transferred everything over. You've got your admin, your marketing, and your contract. What I don't like about the admin is that it basically almost doubled. And I'd want to know, see my note is, what is the breakdown here, and does it include any fees or expense reimbursements to the syndicator? Sometimes you can see a lot of stuff get buried in there as far as what's going to come back to the syndicator. They can start reimbursing themselves for stuff that probably they shouldn't be reimbursing. So you really want to look into that. And then marketing, yeah, this was another big red flag. So I mentioned concessions, but also marketing. This previous guy was spending $164,000 in marketing. Now the new buyer syndicator is going to come in there and miraculously lease the whole thing up and spend a third of what the previous guy was spending. So I don't know how that's possible. And then the contract services, kind of my pet fee. If you see a whole number, 150,000, 000, I don't like seeing stuff like that. As a syndicator, they've got the entire breakdown line by line of what makes up the previous guy's contract services. And they should be able to very clearly go and just delete lines and have a better estimate of what it's going to be. And seldom, if not ever, will it be an exact even number like that. Your utilities are representative of your occupancy. So if your occupancy is, say, 50%, which this one is basically 50%, your utilities are going to be 50% of what they normally are. So actually now live, now looking at this number should actually be higher. It should be closer to $2 million. So that's about $800,000 a year busted. Sorry, I even missed that one, folks. But again, now you can see how hard this can be. At first glance, you look at it, you're like, cool, utilities go up, that makes sense. But then when you actually calculate it, so the calculation would be the $1 million, and then divide that by 0.55% to tell you what an 100% occupied property would be. And just rough guess, it's going to be closer to $2 million. Taxes went up, which is good. I would have wanted to see the breakdown. Also, typically taxes are going to be 80% of the purchase price. You want to know what the tax treatment is in OKC and how aggressive they are, because appraisal district, they can give you some outlandish appraisal that forces you to disclose your income statement in order to fight it. In which case, you would be, they'll be very close to 100%. I've had that happen on a few properties where we did a massive renovation, double the rents, and we were sitting pretty for a couple of years, and eventually the city caught on to the new rents. They gave us a massive tax increase, and we were forced to disclose and show our income statement to fight it, and get it down to a lower number. But by that time, the jig was up, and they knew that, okay, we were now being taxed closer to market. So I didn't do any calculation to see how true this 546 was, but I would ask that syndicator for details. Up here on bad debt, I'm glad they increased the bad debt. That's good. Bad debt's typically when people move out, they skip, they have a balance, they don't pay it. It's a write-off for you. And so on a big turn like this, you are going to have higher bad debt. 3 columns that you should add as a passive when you're doing these. One, you kind of look at a percent column of the GPR. I added a dollars per unit per year. So basically just take that total amount divided by the total units. And then I take it a step further and I divide that by 12 to get my dollar per unit per month, which is mostly important on the top line stuff when I'm looking at GPR, concessions, total. So here I can see that their GPR, basically their asking rent on average, is $967 per month per unit, which is slightly higher. It suggests a drop in the rent. And then here I can see that their GPR is 773. It doesn't match the rent schedule. It's a little bit off, no big deal. But again, just when you start seeing inconsistencies, that should be red flags. I had an old manager at Exxon tell me that you can't always be right, but you can always be consistent. On insurance here on their year one, by doing this dollar per year, dollar per unit breakdown per year, I saw this number 450. Again, that's a nice, pretty even number. That's also a standard benchmark number, which suggests to me that they didn't actually get a bid for the insurance yet. And also more alarming that the previous guy's insurance was 516. So if you're going to update the numbers and use a benchmark, I would at least use the higher benchmark, not a lower benchmark. So for us, we would have probably wanted keep the insurance at the previous guy's rate. And that was kind of what we saw. So really most of the stuff, you really want to look at just the first 2 years. And that's what we did here. Focus on the first 2 years. Again, loss to lease and vacancy are off. So let's go ahead and jump. I did a calculation for you on that. So they don't show the previous guy's loss to lease. So let's assume it's 0. It's not going to be 0. It's going to be some amount. But let's assume it's 0. So that means your GPR is equal to your net. Here we know that they're from their rent schedule, they're going to be renting at $767 per unit. They got 850 units. So their new GPR per month is going to be $652,000. And you're able to calculate by subtracting these two. And then I just did a straight line prorate over 12 months. So that's what this calculation is here. It can be a bit more complex, but a very quick and dirty calculation for you passive out there is just do a straight 12-line prorate over the year. With that, you're able to see that they had a loss to lease over 12 months. Actually, they had a gain to lease. So this is when they're making more income, or at least on the GPR side, than what they're asking for now. But then as you go into the following years, I'm going to jump back to the proforma. I was able to see that they were doing, by breaking out per unit per year and then subtracting these two, subtracting year 2 from year 3. And again, sorry, formatting is kind of all over the place. I was just doing this quickly. You can see that they're increasing rent in the later years by $24 to $26 perfectly fine. I think that's a standard kind of increase. But nonetheless, you're still going to have a loss to lease for that amount. And especially when you've got 850 units. So now when you're in year 2, going to year 3, your loss to lease is roughly $217,000. So that's the calculation I did here and adjusted the gross. So basically, you've got the original GPR and the new corrected GPR below it. And so that's what you're seeing right here. Corrected is just the sum of these. On the vacancy, this is where that gap residential analysis we did comes into play. We took the property, the 45% vacant units, spread them over 4.3 years. And so this is the vacancy you end up getting. So here's the original vacancy. You can see, so they said 2.4 to 700. So immediately they're just like, wow, year 1, we're going to figure the whole thing out. And then year 2, jump down to 8% vacant, which is just not realistic. We showed a kind of more gradual 4-year spread over this. So over the 4-year process, you're going to be getting all those units slowly leased. And keep in mind, you've got people moving out of the property at the same time they're moving in. And the numbers that were shown on that analysis were net numbers for net move-outs and net move-ins. So that's why you can't be too aggressive, because while you're doing this lease up, you're going to have people moving out, etc. So the difference between the two vacancy numbers was about $4.7 million. That's a huge number. On the gross, on the GPR difference with the loss to lease or the lack of a loss to lease by adding it in, because there was a gain to lease in the first year, they actually netted $308,000 more, but that was just kind of a lucky coincidence. But without that, you would have had some significant losses there on the loss to lease as well. So here's our net correction. So you're at about $4.3 million. Jumping back to the pro forma. So we'll jump down to, there's their NOI, and we put in our corrections below it. So you got your loss to lease and vacancy correction, which we just showed you. You've got the marketing number. So we went in and we put the previous guy's marketing number and grossed it up at 2%. And we did that for each consecutive year. So it's 2% bumps on the previous marketing budget. And the same on the insurance, we used their previous number, not the new number, but the actual delta from what should have been there. So we're saying insurance number should be $64,000 higher, and the marketing would be $113,000 higher, and the same for the vacancy. So it gives you a new NOI. For the first year, it's positive because there's the gain to lease. So first year should be actually 1.7 versus the 1.5, 1.6. But then the second year is when it really kind of takes a doozy. NOI of 3.6 was the syndicator's projection. We're projecting 1.6. Not good, almost $2 million spread there. Same for years 2 through 3, 1.5, 800,000, and $400,000 spreads throughout those years. Okay. But wait, there's more. So we didn't have a debt service number. Now you can calculate debt service. There's a bunch of free Excel spreadsheets online for calculating debt service. We went in and plugged in ourselves. We knew the loan amount. Remember, I told you in the beginning, you got to back out the CapEx. It gives you the new original loan principal, but then you've got to bump up that principal over 12 months because that's what they stated their rehab was, so that by the end of the 12th month, you're at $37 million in principal. Now you're paying interest only for 3 years. So those are your 3 years of interest payments, and it's a 5-year hold. So I just calculated this to see, okay, what would the principal be? There's your spread. We're using the LIBOR forecast. Hasn't been updated since 6/24, so it is a little bit outdated, but good enough for example purposes. But nonetheless, you can see that your principal payment is $650,000 per year beyond year 3. And actually even, let me come back. So they're projecting a year 2 refinance, which was in the package. I didn't show it, but that was what they were saying. So year 2, you've got your loan amount, you got your CapEx. So your total loan amount is $37 million. Cap rate of 6.5, because they said the termination cap rate is 6.5%. So that gives you a value of $25 million. And this is based on our adjusted NOI. So that's a delta of $11.6 million. So basically you're upside down in your loan. Now, in practice, in reality, the lender wouldn't let it get that far. They have debt yield requirements for them to do continuous draws. Let's just play this example out. Year 3, which is the end of their loan, so their loan expires at year 3. You're now at 36 million, same calculation. Your NOI is a bit higher at 2.4 versus 1.6. And now you're at almost breaking even, $37 million valuation and $37 million loan. And you haven't paid down any principal, so you really got to hit that valuation. Now, realistically, you're not going to be able to exit. You're not doing any kind of refi cash out, and you'll be lucky to extend the loan. And if you do extend the loan, there's going to be a penalty, probably about a point or maybe half a point if you're lucky, up front that you got to pay per year to extend that loan. That's typically what you see on these things. But let's just ignore that part. Let's just say, okay, there was no fee and they were, this lender is their best friend or something. So now you're paying principal, and that's what we're showing here in the red. So now your debt service is 2.5 and 2.6. So your net cash flow goes down to 650,000 and 1.2 million. And then in year 5, you sell. So you've got the same loan amount. Actually, this loan amount would be $1.2 million less. So let me just go ahead and do that because I made that mistake. Let's go ahead and put this loan amount because you've paid, and this 1.2 million less because you paid principal. Minus 1, 2. Boom. So there's a valuation of $56 million versus, okay, so not bad. So you make, looks like $20 million delta on the sale. So you come out of this thing, again, you're skirting by here. You're not doing so hot. But let's see what the returns look like. So here's what we're listing as the actual LP returns. Just doing an XIR calculation here, you do times 0 as the January 1st, and then first year is December 31st. So the dates are irrelevant. It doesn't matter. I could have put 1990 if I wanted. This is just to do the IRR calculation. You've got the equity amount for the project. The project's going to kick off these amounts on net cash flow as we showed. That's your sale amount. Now we can see what the LP is going to get. So we're showing at 8%. You hit 8% at basically 18.9 million in portion of the sale. Then the hurdle then goes 1.8 million and then 783,000 to the GP. So this is based on what we calculated, assuming there's no default and the lender and everybody just keeps running with it as is. You end the project making 22 million and the GP makes 783,000. This was as marketed from their pro forma, and I calculated their net cash flow using this table here. So they told me that a $100,000 investor makes these amounts. So I was then able to kind of reverse calculate, okay, these are the amounts, and divide that by $100,000 gives me the percent return, and then multiply that by the total equity gives me the total net cash flow for the project. So you can do that yourself as an investor. Breaking that down, plug those net cash flows in here, and you're able to see what they're calculating. So they're projecting $28 million versus $22.7 million. And then here's our first hurdle, and then it goes 70-30. So you get the next 70%. Then over a 12, then it's 60-40. And then over this, it's 50-50. So here's the IRRs. So let's see. It's all summarized here for you. Let me zoom in, make sure you can see this real nice. All right, so key financial metrics, actual versus marketed. So I don't have I left this part off because I didn't want to do the exercise, but the important thing is the sum right here. So total return, 22 million, 22.7. What we were calculating, 28 per them. Investment stayed the same. So the difference in the return was about 24%. Project profit was about 61% difference in return. We were showing 8.9 versus their 14. Project equity multiple. So remember this number? I circled it earlier. So this is the actual This is the equity multiple that the project makes, not the limited partner, but the project. And yet here, over here, LP projected equity multiple. Maybe it's a coincidence they're the same number. Maybe they made yet another mistake. Listed as LP equity multiple, right? Project IRR, so 10.6% IRR for the project. So the property itself, minus, not including any fees, makes 10.6 IRR. They projected 20.73. They were off by 94%. So they were almost 100% off on their number. Investor profit, which we showed earlier, so 8.2 million versus 10.4, 28% difference. Investor equity return, we're showing basically a 1.59 versus 1.76. And then the investor IRR, we're calculating a 9.9% IRR versus their 16.7. And keep in mind, they advertised a 17 to 18%, which I showed here. So even on their numbers and what they were marketing, when you actually calculate it, which you could have done yourself, you calculate what the IRR is, it's even below their range. It's at 16.7. So that's assuming I didn't make any assumptions or nothing. That's just taking their exact number, calculating the IRR with the splits they gave me, and that number was off. And again, as I mentioned earlier, this was still too low for the amount of risk that you're taking on this large 55% occupied property. But the real kicker is you wonder why would they possibly want to push a deal like this? I don't know. I don't know why, but I think it is interesting when you look at the amount of profit the GP makes on it. So on our corrected deal, they still make a good bit of profit, 1.2 million up front and $783,000 over the term of the project. So they make about 25 cents for every dollar the investor makes. And then here on their projected numbers, I guess they thought they were going to make about 5.2 million or 50 cents for every dollar that the investor makes. So you can see here that there might have been some bias and some interest from their side of why all of these partners would be interested in doing this deal. So in fairness, I did reach out to the GP. It was actually my first communication after I did this analysis was, hey, I think there's some major errors here with project. Here's what I found. And the response I got back was, this deal has been blessed by 4 other equity firms, referencing his 4 that are all going to make part of this 5.2 million. And then his 14 years of experience, which only 2 of that is multifamily. So an effort was made to contact the syndicator and tell him, hey, these are the errors I found. Here's the calculations. Do you want to talk about it? Am I missing something? Have you seen this? And response back was arrogance. So anyway, again, tell me what you think. Am I off here? Am I wrong? Did I make some assumptions that you didn't agree? If you're a CCIM, check it out. Tell me what you think about my gap residential analysis. Am I wrong? Am I right? What are your thoughts? And if you're in the deal, I would really be questioning what's going on. And I would be, again, if it were me, I would be trying to get my money out because it doesn't look good. Until next time, until next episode, keep sending me your investor packages. I will do my best to get to them in a timely manner and try and keep the review quick and brief. This one took a little bit longer because it was a bit more involved. Hope you learned something from this. And until next time, see you later.